Welcome to Bloomberg Markets. I'm Sonali Basak, and a happy Fed Day to you. Markets have been speculating about cuts for a long time. Now the day is here. The quick question here, though, the real question is 25 or 50 basis points. Let's get a check on these markets before we start to answer some of that for you. The S&P 500 taking a little leg lower here, about 0.2% lower. The Nasdaq 100 even more so, almost 0.5%. Traders on hold, really. A little bit of sour tone before that big rate decision ahead. The 2-year yields camping out at about a differential of about 5 basis points at 365 on the day, just under 366 really. 10-year yield at 369 nearly. Interesting to see those moves in the bond market heading into that decision. For a deeper dive into the Fed and markets, we're going to bring in Bloomberg's Abigail Doolittle.
Yeah, Sonali, it's interesting to see the S&P 500 down slightly right now. It's the first down day in 8, as you know. So a little bit of sell the news or pause the news ahead of this historic Fed cut. It's going to be the first in 4 years. We don't know if it's going to be 25 or 50 basis points. But right now, we're playing a little bit of a game of chicken, or at least traders are, as the probability of a 50 basis point cut comes off of the highs just a couple days ago. A 70% chance of a 50 basis point cut. Earlier today, 63%. Right now, down at 52%. Former Fed president of St. Louis, James Bullard, told CNBC earlier today that the chances or the odds of a 50 basis point cut overblown. So some informal Fed talk seeming to affect, plus going into that actual meeting. Now, relative to sectors, it's been really interesting. September is historically very bad for the S&P 500, down about 4% over the last 5 Septembers. What we're really seeing this September is a rotation. You can see here on bottom consumer staples. They had been slightly higher, but these are among the best sectors on the month. And of course, utilities, real estate, and discretionary. What do utilities, staples, and healthcare have in common? Well, high dividends. So when yields go lower, these stocks look more attractive. Now, what's super interesting, even puzzling potentially, is the fact that tech simply has not gone along. Tech, the Nasdaq 100, the Magnificent Seven, they peaked back in early July. Right now, that Nasdaq 100 down 6.4% over that time period. In times past, lower yields, more liquidity, cheaper money would have been good for big tech, but that's simply not the case. On the other hand, some of those value-oriented sectors getting a bit of a boost as the money comes out of big tech.
Thank you, Abigail. And the question on Wall Street's mind is, how big will the Fed go? 25 or 50 basis points? Here are what some prominent voices told us this week.
I mean, they're going to do it, 25, 50 basis points. Not going to be earth-shattering.
The market has come to the view that 50 basis points at this meeting is, in fact, appropriate. It's pretty important that the Fed head back to neutral expeditiously, and that 25 basis points wasn't fast enough.
25 or 50, it doesn't make a difference. They're losing sense of the bigger picture. 25 basis points is going to be would be the right thing to do.
We're in the camp of 25, but I always say we have a crystal ball, and at the end of the day, we'll see what the market does. It may very well be that it doesn't make that much of a difference.
If they don't do 50 tomorrow, I'll be shocked. So they do 25 or 50. If they do 25, they'll lather it on pretty quick that they're going to do more later.
And Bloomberg's Michael McKee will be at the Fed today for the big event, and he joins us now live in Washington. And as we've been talking about, everyone's doing bond math. We are also 117 minutes, less than 7,000 seconds away from that decision. Mike, how much does it matter?
Well, it does matter to traders who have placed bets on whether it's 50 or 25. A 25 basically would ratify what's already happened in the markets. The markets started pricing in rate cuts a while ago. A 50 would raise questions about what's next, whether the Fed feels there's something wrong with the economy and they need to be more aggressive, as Bill Dudley was saying, to get down to the neutral rate. The immediate impact of either 25 or 50 isn't going to be very great. We've already seen mortgage rates come down, auto rates come down a little bit, but the cumulative effect is what is going to have an impact on the economy, and that will get maybe a better clue to when we see what the dot plot has in terms of a forecast for the next several meetings or even in the next year.
When we look at that dot plot, how much certainty can traders have in it? You think about those drastic changing expectations, even over the last week, over the last 2 weeks, and what traders expect for this year. Given that there has been such drastic movement, can you expect significant volatility? And Mike, especially if you see that there's not a unanimous decision, how much does that unanimity matter?
Well, the unanimity would tell the markets that the Fed has a pretty good idea of what it thinks is going to happen going forward. If there's any kind of dissent, then you're looking at maybe a little caution coming up in terms of which way they go and how fast they go. So that's something to keep an eye on. We should see volatility based on some of the economic data we get going into next year. But right now, it doesn't look like we're going to see a repeat of the beginning of the year when we had a big jump in inflation, or the month of July when we saw a jump in unemployment. At least that's the way the Fed's betting at this point. So you can probably count on the dots maybe to the end of the year and maybe the first couple meetings of 2025. But after that, it does become a bit of speculation.
Mike, we thank you so much. We look forward to your coverage really just less than 2 hours from now. We're going to bring in now BlackRock's head of global fundamental fixed income strategy, Marilyn Watson. And there's so much discussion about 25 or 50, Marilyn. To you, what do you expect and how much does it matter?
So as you say, there has been a huge amount of speculation and focus in the past couple of weeks in particular. Our economists still think that it's likely to be 25 basis point cut, but it is a pretty close call. I think what's really important is after we get that announcement, then what we see in terms of the summary of economic projections, what the medium dot and what the FOMC members are expecting in terms of then the trajectory of further cuts coming along. We certainly, at the moment, from June, the dots are really only pricing in 1 cut this year. We think that's likely to increase to around 3 this year and maybe to around 4 for next year. So that's going to be very, very important. And I think also when we hear the statement coming out of the Fed as well, when we have the Q&A and the press conference, but I think really, the most important thing is that we will see today's cut. But then going forward, what will be the trajectory going forward from that? And I think it's important to highlight that the US economy is still in pretty good shape. Even if we were to get a 50 basis point cut, it's not, signaling that there's a recession. We still think that while it's moderating, the US economy remains on a pretty decent footing, and there's no catalyst that we can see that would suggest that there were to be any kind of recession coming up soon.
That's interesting. So that you would believe that even if we saw a 50 basis point rate cut, because there is a view out there that 50 would signal that things are worse than it seems. The people who are calling for 50, some of them, Claudia Sahm being one of them, believe that part of that would be because the underlying labor market may be weakening faster than was initially anticipated. What would that say to you? How would that change your strategy?
So I think, when you look at the labour market, it is also, it is moderating, but it still remains, on a pretty decent footing as well. I think when you look at the labour market, it's not only important to look at the demand side, and while we are seeing, job vacancies coming down to more towards trend, they still remain at pretty decent levels. But I think it's on the supply side that it's particularly important to look at. When you look at the number of, the high level of immigration in the US, the number of people looking for work, the number of people who are looking to be employed. I think that's where the key will be to focus on that. But it's, again, in terms of the labour market, we're not seeing a huge decline in terms of demand. It's just moderating back to trend. So I think overall, when we look at economic activity and the labour market in particular as well, now the Fed has pivoted from spending a long time focusing really on the price stability element of its mandate. Now it's focusing on maximum growth, and that, as you know, is with the labour market. They're focusing on that now, but I think they have been very, very patient. And I think from everything that we've heard from them and all the data that we can see, again, the labour market is moderating, it is weakening, but it's actually more going back to a trend level.
So what does this mean in terms of how you're positioned in the bond market right now? Because given that we are really on a knife's edge here in terms of which way the Fed could go in just a couple of hours from now, does this mean that perhaps the market has corrected to the point where value is hard to find?
So the market has certainly priced a lot in terms of what it thinks the Fed may do. When we look at the US Treasury curve, then at the moment we are pretty happy being in the value of the curve. But I actually think that if you look globally, and also if you look in the investment grade or even high yield sectors in the US, we still see a lot of good value, and we also see a lot of opportunities for relative value trades where we can actually take advantage of some of the price dislocations and some of the volatility there. We also like in Europe, again, we like a lot of investment grade positions. Some of those are in relative value trades, some of them where we then hedge them back to the dollar and we can get a pickup in yield there too. And globally, I think given the massive volatility that we've seen in the past couple of years when we saw rates go up quite significantly, we've seen a huge repricing, and now we are getting very, very attractive yields in a range of different asset classes. So we're looking to be diversified and really, we have positions on where we really feel that we have a very high conviction that we like the value, and we also like the level of yield that we're getting for a relatively low level of risk.
Marilyn, we have to leave it there. We're looking forward to this rate decision and to having you back soon to talk about how you are positioning after we have more facts on our hands. That is Marilyn Watson from BlackRock. Now coming up, growth is outpacing value this year, but with the Fed cutting rates, that could change. We're going to talk about it next with Nir Kaysar. This is Bloomberg. Welcome to Bloomberg Markets. I'm Sonali Basak. I'm going to take a page out of the AQR playbook for a second here and take a look at what's happening in the differential between growth versus value. I'm going to do it with the Russell 2000 Value Index first, because it has been up about 6.7% this year so far, and you can see it there only in recent weeks, over the past 52 weeks in particular, starting to get more steam and starting to catch up a little bit to that Russell 2000 Value Index, which has been up by 20% this year, or actually the growth has been up by 20 and the value has been up by 6%. So you see that spread starting to compress. And the big question is what that looks like after the Federal Reserve starts cutting interest rates. We're counting you down to that Fed decision. Bloomberg Opinion's Nir Kaysar took a special look at how stocks perform when the Fed cuts. He joins us now. There has been a lot of conversation about small caps in particular, which is why I use those indices in particular. But I also think it's where you see the bigger differential between growth and value. At the end of the day, do you bet on value at a time where leverage is starting to get cheaper once again?
Hi, Sonali. Well, it's a good question. I looked at the historical record to see, what we could glean from there. And what I found is that in previous rate cutting cycles, I looked at 13 of them, value beat growth every single time. However, I should also note that in a couple of years ago, when the Fed was raising rates, I looked at the same question, and I found that value had beaten growth most of the time, even when rates were going up. So, the record does show that value tends to win a lot over growth. And so, in general, if you are a value investor, I think you should be heartened by that. However, if you're not a value investor, I'm not so sure that you should pivot to value because we're in a rate cutting cycle. I think you should ask yourself, given that the historical record shows that value has outperformed growth most of the time, why am I not in value? And if there's a good reason why you're not there, you probably shouldn't be there now.
Something that's interesting about this dynamic is also a matter of definitions. Nir, how do you define value in this market?
Yeah, that's actually a great question, because it really goes to what do we know and what does the data tell us. So in the data that I'm referring to, value is sliced based on the price to book ratio of companies. However, there are many ways that you can define value fundamentally. I mean, you can look at sales, you can look at earnings, you can look at very different things. And when we look at different things in general, over the long term, the results tend to be roughly the same, but over shorter periods, they can be very different. And I'm referring specifically to the last 20 or 30 years, where companies have become less asset rich and more intangible value rich, let's just say. And companies that are defined based on value, based on price to book, looking at the asset value, have not done particularly well, whereas companies that have been measured based on, let's say, free cash flow or earnings have done well. So your definition of value does matter, and you have to look at that closely, I think.
You know, it's interesting. You would wonder whether it's kind of the Berkshire Hathaway playbook here that's helped it do so well in this environment where people are believing in value once again more significantly. I'm wondering if kind of the definition of value has changed a little bit, particularly as you look intra-sector. If you think about the Mag 7, if you think about those big tech stocks, even if you think about, you know, what's happening in AI and semis, do you parse that universe to find value there?
Well, I think you have to confront this question because if you define, for example, if you define value based on assets, you're going to get a lot of financials. And that's going to be what it's going to be. I mean, financials haven't been great over the last couple of decades, let's just say. But if you define value based on earnings, based on the income statement, you're going to get a lot more technology. And obviously, technology has been the place to be. So so the definition does matter, like I said, in short periods specifically. However, we have had a big, since roughly 2020, we've had a big turnaround in value. You probably remember in the late, 2010s, a lot of people were declaring the death of value and Mag 7 was everything and no one wanted to touch value. And of course, those are the times when you usually get pivots historically, and we did get a pivot and all value did well. The question is what's going to happen going forward? And my guess is that at least in the short term, the definition of value is going to matter.
Is Apple, for example, a value stock? I think these are really important definitions to really drill down on, because if we think about the future and people who are worried about valuations, how do you think about kind of where are the safe havens even within that fast-growing technology industry?
So let's look at it just from an income statement perspective, and I think this is where Buffett is so interesting, right? When Buffett started to buy Apple in 2016, I don't know if this is very well appreciated. Apple was as good a company, as high quality a company as it is now. However, it was trading at roughly 11, 12 times earnings. So it was both a value and a quality play, and maybe even a growth play. I mean, you could slice it that way if you want. However, today, I think it's very difficult to make the argument, although Apple is still high quality and to some extent growth, it's no longer a value play, I think, by any definition. And in my view, that's why I think Buffett is paring back his position. Some of it is risk management. But if Apple were trading at 11, 12 times earnings today, I'm pretty sure he wouldn't be cutting it back.
Nir, really quickly here. There's so many expectations out there in the market right now when you look at market pricing, especially relative to what economists think. Most economists don't think that the Fed is going to go by 50 today, but the market certainly believes so. So if they don't get the 50, what does the market look like?
Going to be relatively tame. My personal view, Sonali, is that they should go 25 bips. I don't mean to open that can of worms, especially this late in our time together. But I think that there is enough flexibility and that financial conditions in general have eased enough that whether they go 25 or 50 today is not going to make a big difference. What is going to make a difference is what they signal. Is their intention to catch up to the 2-year, which is currently at 3.6. That's going to be the bigger story. If their intention is not to go there, the market will react. Otherwise, I don't see the 25-50 being a big deal personally.
Nir, we thank you so much for your time. Happy Fed Day to you. That is Bloomberg opinion columnist Nir Kaisar. And coming up, we're going to dive into today's big take. It focuses on Titan, Citadel, and Millennium, and what to do with all the hedge fund cubs that are popping up. I've been watching this story all year and very excited to talk about it. We're going to bring you those details next. This is Bloomberg. Welcome to Bloomberg Markets. I'm Sonali Basak, and time now for today's big take. Hedge fund titans like Ken Griffin, Citadel, and Izzy Englander's Millennium Management are at the top of their game when it comes to the number of startups they've spawned in recent years. But investors might be taking a risk piling into their assets in these new firms with no guarantee of success. They are new firms, after all. Joining us now for more on this story is Nishant Kumar, who was all over this story, author of this big take. And my question is, can Ken Griffin be the new Julian Robertson? Can he be that kind of benevolent godfather of the industry as he's seeing, let's say, Ken's Cubs take shape?
It seems so, whether they like it or not. Both, I would say, Izzy and Ken Griffin, their firms are source of the largest number of startups, and some of these startups are really massive. So I think we are seeing some initial signs of both of them playing the new godfathers for a new generation of hedge fund startups.
You know, what's interesting about the Millennium part of this is that they seed their own pods. What's the biggest differential here to see Millennium perhaps seed other firms, and we know there are some notable names that they did not play a role in here, versus what they are doing within their own ranks?
So this has been a growing trend, and Millennium is by far the most aggressive in terms of seeding its managers, or even those managers who are outside. 7 in every 10 multi-strat hedge funds allocate some money to outside portfolio managers. So that's picking up pace. And this is, if you can't hire them, just give your money to them. That's the second best option.
You know, it's interesting. I do want to move on here to another story as well, because Victory Lap here on a massive scoop that you had, and that is Steve Cohen stopping trading for 0.72, another massive thing in the world of multi-strategy funds. What does this mean for this generation of investors?
Well, we are definitely seeing, maybe it's an inflection point where the industry is moving on. We are seeing this generational shift, and Cohen has done it for 40 years. He has proved himself, and his book is not large enough, given 0.72 now manages $35 billion, to have a huge impact. So, I mean, he finds his experience, better used in training and mentoring the new generation of Stephen Cohens that, can sprout from 0.72. So it's logical next step forward.
Do we know, though, how much it has to do with him also trying to focus on other personal ventures like running the Mets?
Well, I don't understand that game at all. I come from India and I only understand cricket. But I'm sure that must be, and I'm speculating here. I mean, I have no way to check or confirm how much, that's playing a role in this.
It's fascinating. Bloomberg's Nishant Kumar. Please check out his ticker on the Bloomberg terminal here, because there are a ton of scoops to find there. Now, coming up, some believe that the U.S. election cycle could affect how the Fed and Jay Powell act today. We're going to discuss politics and the central bank next. Of course, we have that massive rate decision coming up, and it's the last one before the U.S. election. There is another Fed meeting right after, but it is unclear what the policies ahead will look like for the economy. We'll talk all about it. This is Bloomberg. Welcome to Bloomberg Markets. I'm Sonali Basak, getting a quick check on these markets to you as we count you down to that Fed decision. The S&P 500 looking to turn into the green. Of course, we are roughly unchanged for the day. It's been fluctuating between pretty much unchanged and losses throughout the day. The NASDAQ 100 also looking to head into at least flat territory for the day. Remember, the S&P 500 has been on a 7-day winning streak until today. So you're seeing that rally start to stall out. The 2-year yield movement about 4 or 5 basis points here at a 365. Pretty interesting, given that we haven't seen the news yet from the Federal Reserve. But the 10-year yield also 3-4 basis points of movement here to about 368 on the day. And a lot of questions on whether we've overcorrected or if we are standing at Goldilocks just right. Some midday movers on the equity side here with Bloomberg's Abigail Doolittle. Abigail.
Sonali, stocks may be relatively flat on the surface, but beneath that surface, we do have some bigger movers. The worst decliner for the S&P 500 right now, ResMed, that sleep med tech company, down 5.7%. You can really see this plunge here in this 2-day chart. It's the worst day going back to July. This after Wolfe cut their rating to an underperform on a decreasing, a less attractive risk-to-reward profile based on their proprietary physician survey work. Wolfe believes a launch from Lilly poses significant patient funnel distortion risk. I think that's a fancy way of saying that some of their business could go to Lilly. They've also cut their price target to $180, significantly below where ResMed is trading right now. Let's turn to what's helping out the S&P 500, though, and this, of course, has to do with Super Micro, and this is another Needham & Company, or excuse me, it is Needham & Company, upgrading shares to a buy on a first-mover advantage in AI. The stock up 1.6%, even as NVIDIA, last time that I looked in that S&P 500 in the Bloomberg terminal using the MOVE function, that MOV function, NVIDIA had been lower. And then finally, let's take a look at one of the big point boosts and percentage movers for the S&P 500. Apple up 1.8%. JP Morgan is in talks to take over its credit card venture. This after Apple made a push earlier this year to cut its ties with Goldman Sachs. There's also a bounce back here, of course, Sonali, from Monday when there were some negative reports around that iPhone 16. It seems as though some buy the dippers are out on Apple.
Thank you so very much, Abigail Doolittle. Now, lawmakers in Washington are also keeping a keen eye today on the Fed's decision. Republican Senator Bill Hagerty told Bloomberg about his view from Capitol Hill.
It needs to be data-driven. I'm going to be very interested to see what Chairman Powell has to say as he makes his announcement tomorrow. One thing I'm also very interested to hear him talk about is the size of the Fed's balance sheet. We've not heard enough about that, but a $7 trillion balance sheet is inherently stimulative as well. That cuts against the rate increases that have been put in place.
And it's 47 days until Election Day in the United States. And for more on how politics might play in the Fed's move today, let's bring in Bloomberg's Kayleigh Lines in Washington, who, of course, always comes in with facts. And it's interesting. I want to ask about the Fed's politicization here for a minute and how Republican and Democratic senators feel. But we also have these headlines coming out that I just want to talk to you a little bit about first, which is that Harris is topping Trump in Michigan and Pennsylvania, according to a Quinnipiac poll, and that in Wisconsin, they're running about even. What do you make of those headlines?
Well, those three states that you just mentioned, Sonali, are crucial because they are what we call the blue wall. They are essentially must-win states for Kamala Harris. If she doesn't get one of those, she's going to have to make it up with electoral votes elsewhere, like in the Sun Belt, where Democrats have traditionally, in this election cycle at least, not been polling as well as Donald Trump, although Harris has made up some ground compared to where Joe Biden was when he left the race. But these states, Michigan, Wisconsin, and Pennsylvania, of course, are states that are heavily concentrated in manufacturing, a lot of union labor involved, as she's tried to pitch herself like Joe Biden as someone who would be a pro-union president. Of course, the selection of Tim Walz as well from neighboring Minnesota kind of factored into the thinking, shoring up support in these critical states. But it really is about the math and the map here, Sonali, especially the state of Pennsylvania with its 19 electoral college votes is really a must-win for both campaigns. The road to the White House effectively runs through Pennsylvania, which is why polls like this one are so important to watch.
So separately, when you think about Pennsylvania, I think that what you're saying is very important here. And to see her leading in the Quinnipiac poll, even more striking. What is it about her perception in Pennsylvania that is going to help her or is helping her at this juncture, and how fragile is it?
Well, I think it's hard to narrow down one thing. I think what we have seen across the polling is there is just more voter enthusiasm for her candidacy than there was for Joe Biden, who, of course, was dogged by many issues, but most importantly, his age, which is something he simply could not change. We also have seen in polling, and this was true of the Michigan Ross Business School and Financial Times poll that came out a few days ago, that Harris is actually starting to poll better on the economy. In fact, in that FT Michigan survey that I was referring to, she was trusted more on the economy than Donald Trump. So the way in which she has been able to make up ground in areas like, according to our Bloomberg Morning Consult poll, trust in housing and helping the middle class, those kind of things could be some of the reasons why she is able to make more groundway in these battleground states where the economy, as we know, is the top issue.
You know, it's interesting. I was down in Washington just a day ago with you, and I had wanted to switch gears here to the Fed because I saw Patrick McHenry talking to Wall Street Journal reporter Nick Tamaros saying, you know, everyone thinks that we're trying to politicize the Federal Reserve here, but the Democratic senators, Elizabeth Warren, then you have Sheldon Whitehouse, John Hickenlooper, all sending a letter to the Fed to cut by 75 basis points. I mean, the consensus, at least, is they all want rates lower, I suppose. But how politicized is this issue at this very moment heading into this 2 p.m. decision?
It very much is. Of course, that letter from Elizabeth Warren was a push for a 75 basis point cut, but she has co-authored a letter like this to the Fed for every meeting in 2024. Going back to January, she has been pushing for rate cuts. It started as a concern over the housing market in particular. Now it has morphed into more concern about the labor market and the potential for an economic downturn overall. That said, while we have seen Democrats pushing it, we have seen Republicans, specifically the standard bearer of the Republican Party, the Republican presidential candidate Donald Trump, also talking about how he believes the president should have input into Fed decisions. He said that to our colleagues in a Bloomberg Businessweek interview just this summer. He has since defended it, not saying that the Fed necessarily has to listen to the president, but the president should at least be able to give views there. So Fed independence, very much an open question. Of course, Chairman Powell, I'm sure, will maintain in the press conference today that they do not operate with politics in mind. But even if the Fed isn't influenced by politics, politics can very much be influenced by the decisions of the Fed, especially if it weighs in on consumer sentiment or changes consumer sentiment as they get ready to head to the polls in November. This is, of course, the only decision the Fed will be making prior to the election. They will have to make one just days after the vote.
Kayleigh, we thank you so very much for your reporting. Looking forward to your reporting later as well on Balance of Power. And for more on how the U.S. economy might respond to today's Fed decision, let's bring in Ellen Mead. She's former special advisor to the Fed Board of Governors, and she has an intimate understanding of how these decisions are made. She's also, of course, a research professor of economics at Duke University. And I've got to first just get your opinion. If it were you making this decision today, if you were leading the Fed, 25 or 50?
I think I'm at 50. Last week's data, the CPI Wednesday, followed by the PPI Thursday. A lot of inflation forecasters see pretty good news out of that monthly likely PCE number in August. And the Fed's staff, of course, is very good at incorporating those numbers and putting them together. I think that's why you see the shenanigans you saw last Thursday. I think there probably was a message communicated from the Fed to get 50 back on the table. And now we have market pricing looking, I don't know, the last I looked, nearly 50-50. But I think the thing is that in November, by the time you get 2 days after the election, you've had 2 more months of data, 2 more months of payrolls reports, of inflation numbers. And, you know, if the Fed is running a little slow and the labor market layoffs start to show up, it's going to be behind the curve by then. So I think they move a little faster today at 50. But of course, both are in play.
So a question I have about the call for 50, is it more predicated here on the distance that we stand today from the neutral rate, or is it more predicated on concern around how quickly the labor market is softening?
Well, I think you can make arguments on both. I'm not in the Fed's camp of seeing the neutral rate as somewhere still in the 2s. I think it's more likely in the low to mid 3s. But the Fed doesn't have to completely figure that one out until we get into 2025, you know, exactly where the destination is. I think the real argument is, what if in the next month or so you start to see a dramatic slowing in the labor market, something beyond what we've seen? You start to see a pickup in layoffs. Are they really going to hold an unscheduled meeting to make another cut? I don't think so. I think they're going to wait till November. And so, you know, maybe the balance of risks right now argues for taking the 50 today.
It's interesting because even though you are on the side of 50, there are still many, and many would say out of the surveys here, the majority of economists still calling for 25. The market pricing has moved towards 50 in a pretty drastic way in recent days. And you still do speak to a lot of folks that are making decisions on the back of these interest rate decisions that could impact the real economy, Ellen, right? You talk to folks across the private sector. What do they need at the end of the day to make sure that they can help land this economy softly, that these folks are not having to lay people off at this juncture, that they can navigate any potential slowdown?
Well, I think, you know, I think 50 is the right answer. I think the reason market economists have stuck with 25 is because of the unorthodox set of communications over the past week. You know, Powell clearly set up the start of the easing cycle, left the door open to either 25 or 50. And then the two remarks that John Williams and Chris Waller remarks on the morning of payrolls Friday suggested that really, while the door was open later on to 50, it was going to be 25 this time. That might have been just too much. Powell thought the weight of evidence was starting to shift after he saw the price reports by last Thursday, and felt that you needed a more even balance. I think, though, it's a little more confusing than it would be if we weren't in blackout and we had, clear indications. But for sure, they're going to be talking about both. They have been talking about both. They would have been talking about both possibilities, even if we hadn't seen what we've seen in the last week.
Well, hopefully the press conference will certainly answer some questions, not just on today, but on that road ahead. Ellen Mead, research professor of economics at Duke University. We thank you so very much for your time and your analysis on Why 50. Now coming up, GM shares hitting a session high. Some news tied to its electric vehicles helping to charge those shares forward. It's our stock of the hour next. This is Bloomberg. Welcome to Bloomberg Markets. I'm Shonali Basak, and it's time now for the stock of the hour. We're going to look at GM today, which hit a session high after it announced electric vehicle customers are going to get access to Tesla superchargers starting this month. Owners of GM models can plug into 17,800 of Tesla's fast chargers with the purchase of an approved adapter, which sells for $225 at a GM dealer. For more on this, we are joined by Bloomberg's David Welch, who covers autos in Detroit, and fascinating ways to see these companies partner together to this effect. How does it move forward the effort here in a year where there have been a lot of concerns about how quickly EVs can roll forward?
This should help GM with one of the biggest barriers that people have when they consider an EV, which is if they take a road trip, can they charge? I drive a lot from Detroit to Pittsburgh. On the Ohio Turnpike, there are plenty of Tesla chargers at all the service areas. There are others there, but they're not so visible. So people do see Tesla chargers at places like that. They also know, if they do any research on EVs, that Tesla by far has the most reliable charging system. So if you can plug a GM EV into that, hey, that's great. And look, this comes at a very opportune time for General Motors. They're ramping up production of the Equinox and Blazer EVs, which are their cheaper ones. So that could give those potential buyers access to charging.
This seems easy, right? You buy a adapter for $225. You find a Tesla charging station, I suppose. And how does this really meet the need at the end of the day? I mean, what are the complications that are still there? Well,
it's really like anyone who owns an EV, like you quickly learn you download apps for a variety of chargers. They have different ones in Canada, different ones in different areas because GM partners with about 9 different charging companies. There's ChargePoint, there's EVgo, there are others. But, EV owners, they have access to these apps. They have their credit cards loaded on them so they can automatically pay. In some cases with GM, it just works seamlessly with the car if you're charging it at some of their approved partners' chargers. But in this case, look, you just hook the adapter up when you plug the charge port, the charger into the charge port, and you start charging. And you can get, variously reported, but you're looking at you can get from 20% to 80% in, say, 30 minutes. That's a rough estimate. It varies by EV, but you're getting a pretty good top up in a short period of time if you're out on a road trip and you need to stop, grab lunch, and you come back and you got a pretty good level of charge.
20 seconds here, David. Is this EV boom going to make driving manual obsolete?
Driving manual is almost obsolete except for Luddites like me and performance geeks and people who own Jeep Wranglers. So yeah, it'll usher in quickly something that's already been happening unfortunately, for quite a while.
That was a selfish question. Maybe people will make me stop learning. But David, we thank you so much for your reporting from Detroit. Certainly an interesting move over by GM. Now coming up, we're going to go back to the hedge fund world. That's what happens with the Sonali Basak 12 p.m. takeover. We're going to talk about Citadel. We're going to talk about Citadel Securities, the division now, backing away from a plan that it has had in place for nearly a decade. We're going to talk about what it means for the market maker that is backed by Ken Griffin next. This is Bloomberg. Welcome to Bloomberg Markets. I'm Sonali Basak. We're going to talk about a different part of the Ken Griffin empire now. We're going to talk about Citadel Securities. It has quietly shelved plans to become a bond dealer that trades directly with the Federal Reserve. And for nearly a decade, the firm's executives had seen that move as a step toward its goal of being a dominant force in the trading of treasuries. Turns out they're becoming a dominant force in a different way. For more on this, we're going to bring in Bloomberg's Catherine Doherty, who's been covering this story. And I think not a lot of people really understand here how important the Treasury market is to the growth and expansion of Citadel Securities. How are they able to really succeed in this market the way they have been without becoming a primary dealer?
So when the firm first entered the Treasury market, they signaled that they wanted to become a primary dealer to really show their commitment to the space. And that commitment over time has been shown in other ways. So in the secondary market, they've been able to build to basically be a presence that has become so big, they're no longer seeing the primary dealership status as necessary to cement what they already see as their position in the marketplace. So before, when they were really setting their goals and saying, we want to be a dominant player, we want to serve our institutional clients in a way where they see us as a necessary and helpful player, well, at this point, they're already doing that. They've achieved that goal. And so the status and the primary dealership process, they've put on hold.
You know, it's fascinating because back in the day, people would say over at Goldman and the big trading desks here, Citadel Securities, they win on technology, okay? That they're the big kind of techie firm that really wins when things move fast. Mm-hmm. But in more recent years, they've hired some significant talent. You think of Mike DePass, who is a very big part of this initiative here, brought over from Bank of America a number of years ago. And all of a sudden, you have significant talent going around, calling all of Wall Street and really having that personal touch. What does this mean in terms of how their business fits into the world of big ticket trading?
That's right. So right now, we also have to talk about Europe. They've been expanding in their Europe rates business, and they've hired to do that at traditional Wall Street firms. So today, there was actually the announcement that they were approved to participate in German debt auctions. And that actually shows a signal to the marketplace that they want to be a present and supportive player, a liquidity provider in Germany. And the next step will be, do they go to other countries in Europe and look for similar opportunities? And the signal here is that that could be the right move for them, because in Europe, the primary market and the secondary market are more intertwined. Whereas in the US, what's started to occur is that primary and secondary are more separated. And again, Citadel has seen that it's cemented its place in the secondary market. So that primary dealership is not positioned in the same way that it is across overseas.
Just about 30 seconds here, because the other thing people really knew Citadel Securities for was because it handled so much retail trading volume. So how much does it really mean for them to be in that world of debt issuance across countries at this point? I mean, how big of a business is it?
This is really building up their institutional side of the business. When you think about Citadel in retail trading, very dominant in equities, but for Treasury market, these moves, and especially when you think about primary dealership, which it's no longer looking at right now, but in the announcement today in Germany, that's really being a player in the institutional space.
Catherine, we thank you so much for your time. That is Catherine Doherty with Bloomberg News. Of course, fascinating changes in the trading landscape and a lot of changes in market structure in the Treasury world as well. Of course, we'll be looking forward to a Treasury market conference in just a couple weeks here. And we're going to take a look at markets before we let you go. An hour away from the Fed's big decision. The S&P 500 turning green, 0.1% higher. NASDAQ 100, so too. That KBW Bank Index still running flat. The Russell 2000 not getting a lift, 0.1% lower. Quickly looking at treasuries before that big decision, the 2-year yield 4 basis points higher, hanging out at 364. That does it for Bloomberg Markets. I'm Sonali Basak, and this is Bloomberg.